Hello again, everyone, and happy holidays. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today is New Year's Eve, December 31st, 2023, and I wanted to just kind of put an end to this year and give you a few things that we are watching as we move into the new year before I go out and celebrate with my family and friends. In our previous December 18th Following the Money podcast, we said that our Asbury 6 risk management model had been on a positive or bullish stance as of November the 2nd. The benchmark S&P 500 has since risen by 11%. On December 18th, we also said that our SEAF model, SEAF is an acronym for Sector ETF Asset Flows, had been overweight the technology sector or the ETF XLK since October the 29th. The SEAF model had actually exited that trade or that idea this past Friday, December 29th, for a 13.8 outright gain, while outperforming the S&P 500 by 3.5%. Today, I'll be talking about what our latest analysis and data-driven models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be on defense and protecting your capital. Now, let's follow the money. In this new video version, I'm going to take you inside Asbury Research's Research Center. This is the password protected part of the Asbury Research website to show you some of our data-driven models and ideas that we are the most focused on right now. So what you see on your screen right now is the landing page. If you go to asburyresearch.com, you've got the landing page here. And just for your information, if you want to find out a little bit more about our models, right across the top here, if you click models, this will take you down and you could look at the models individually, and there's some charts and stats there for you. If you want to contact us to get further information about our services, you can go right to the end here and you could click the contact tab, fill in some basic information about yourself, and we will reach out to you and try to help you in that way. But for now, let's go back to the landing page and go to the Research Center here. That's this orange kind of hamburger type looking orange button here, and we log in. This is what the Research Center looks like. We have a message board here up on top, and the first thing that we're going to look at today is one of our two tactical models. We have the Asbury 6 is one of those models, and the Correction Protection Model, or CPM, is the other. Today we're focusing on the Asbury 6, so we click there, and what we see here is the latest update of the Asbury 6, which is through the end of the year, which is through Friday. As we said earlier, the Asbury 6 had been on a positive status, a bullish status, since November the 2nd. What does that mean? It means when 4 or more of these 6 constituent metrics have turned green, green is positive, you can see all of the dates are inside of these cells. So when 4 of 6 are positive, the model itself goes on a bullish status, a positive status. That's been the case since November the 2nd. As we mentioned, the S&P 500 has gone up by 11% since then. So we're going to start the new year with a bullish status for the Asbury 6. The next thing that we want to look at is sector rotations. We're going to go back to the Research Center, and we're going to go to our SEAF model, which is right here. We're going to take a little closer look at SEAF and try to explain to you how SEAF works. SEAF model, unlike other models that we have here at Asbury Research, is based on the movement of money around the 11 sector spiders, which together comprise the S&P 500. And what I've done, I built this model, I don't know, between maybe 6 and 8 years ago. I've built a methodology that measures the velocity of money moving around those 11 sector spiders, and we've ranked them 1 to 11 in 3 different time frames. Trading, which is weekly, tactical, which is monthly, and strategic, which is quarterly. And the fastest money moving in for that particular time frame gets a score of 1. The model, by the way, is updated once a week, usually on the weekend. It's usually available to subscribers by midday on Saturday. for execution of any changes to the model on the opening the following Monday. So let's just look at trading here for an example. So last week, the last week of the year, the fastest acceleration of money going in happened in the financial sector and in the real estate sector. Those are 1 and 2. The fastest of acceleration of money going out was in the technology sector, which again is why we took our profit on that idea that we had since October in technology, because now there's some pretty aggressive money starting to move out of there. And number 2, in terms of speed of money out, was in the energy sector. And then what we do is we add up the 3 time frames, and anything between 3, which is the best that you could get, that would be number 1 in all 3 time frames, all the way down to 15. Those are the favored sectors. So right now, the top 3 favored sectors that we have are financials and real estate, and also XLC, which is communication services. Another feature of the CEF model, as we update it every week on the weekend, so it represents the movement of money from the previous week, is our rainbow charts. And what the charts do is show the actual historic movement of that particular sector in terms of our own ranking system for the CEF model. So here's real estate. I had mentioned real estate earlier. The ticker is XLRE, and you can see that real estate moved into a favored ranking. That's the green highlight here up on the top of this chart, upper panel, I should say, of this chart. You can see that it moved into a favored ranking back here in November, on November the 29th. It's still there now, and so far the XLRE has outperformed the S&P 500 or SPY by 4%. You can see the flip side of this, where back in February and March, you can see that for the most part, this was an avoid ranking for XLRE, and look what happened. This chart, by the way, down on the bottom is a relative performance of XLRE versus SPY, or the S&P 500. So you can see when it was on an avoid ranking for much of this period, and here, XLRE, or the real estate sector, was underperforming the S&P 500. So that's how that particular model works. The other thing I want to talk to you about today is seasonality. Seasonality is kind of a tertiary indicator for me, but I pay attention to it when I think the market is offsides. The market is offsides here according to our metrics in terms of being overextended. You can see it in standard deviation. You can see it in put-call ratios and market breadth and investor sentiment. A lot of different metrics are suggesting to us that the market is not a little, it's actually a lot overextended on the top side. So now I want to look at seasonality and look at what the norm is for this time of year, knowing that the market is overextended. So this is the seasonality for the first quarter of the year in the S&P 500 based on data that goes back to 1957. So you've got 13 bars here representing the 13 weeks of the first quarter. And what we can see is by far the strongest week of the entire quarter is the first week of January. That's the week of January 2nd, or just a couple of days from now. And then the following period, barring a couple of mediocre strong weeks, we've got one here at the end of January, we have one here in the middle of February. We're pretty weak here through the end of February. So I'm taking what I see now in terms of being overextended, and I'm looking at the seasonal norms, and that suggests to me once we get through the first week of next week, it's time to be careful. It's time to start paying attention to metrics that are going to tell you when the market actually starts to turn. How do we know that? The Asbury 6 is our go-to, along with the correction protection model, or the CPM, tell us that. So the next signal that we get, a negative signal in the Asbury 6, is going to be particularly important to us because of the setup that we have going into the new year. Another item that I'd like to discuss with you is that, let's move right back here to our landing page first. I'd like to announce that I will be presenting Asbury Research's 2024 market outlook for Fidelity Investments on this upcoming Thursday, January the 11th. This will be my 11th year presenting educational webinars for Fidelity, and I hope you'll attend. You could go to Fidelity's website to find out a little more detail about this. Finally, for those that are interested in the Asbury Research data-driven models, we are happy to announce that investors can now trade the CEIF model and the Correction Protection Model, or the CPM, through a relationship that Asbury Research has made with an independent registered investment advisor that we have authorized and partnered with to execute those trades for you within your portfolio. Contact us via the Contact tab, again, right here through the Contact tab at asburyresearch.com, or call Asbury Research's phone office at 888-960-0005 for further details about this. So there it is, our latest bi-weekly Following the Money podcast for today, and a short synopsis of what we think is particularly important to pay attention to as we move into the new year. We will see you again right here in about 2 weeks with our next Follow the Money podcast. In the meantime, you can subscribe to the Asbury Research channel on YouTube for more podcasts and data-driven trading and investment information just like this that we had today. If you're interested in getting further information about our premium services for individual and professional investors, just visit asburyresearch.com and use the Contact tab to connect with us. Happy New Year, and we look forward to presenting many more of these for you in 2024.